Hey there, it's month 8, and that is time to buy another stock.
If you've been following along, we're buying a stock once a month, $400 a month, and this is month 8. All of this is to help you create passive income so that money works for you and you stop working for money over and over and over again. Brian normally gives me a list of stocks and he says, okay, let's look at these together, and we do.
The problem is we are getting diversified. We have stocks and sectors that is diversifying our portfolio, but that leaves those out from my list. So now I've got less and less that I could pull from. For the first time ever, I pulled a list of 16 stocks, and we didn't choose one of them. They all were problems.
Everything on the list. We went through the whole list, but everything on the list we looked at, there was a problem. Like some stock had a demon here, or this one's books looked bad, or this one had net revenue that was cratering off a cliff.
Yeah.
All of this is just to indicate that you've probably seen it in the news. They're talking about inflation. They're talking about, the recession that's coming next year and all these horrible things that's showing up in the stocks. You're seeing net revenues decline. You're seeing cash flows decline. It makes it very difficult to find a stock in a position that's at least well positioned to weather that storm. Now, we did find one. We did pick one, but we went through quite an interesting scenario just trying to find that. Because like I said, we had a few of them in here that they look good on paper, but then you looked up some news articles and it was like, what is going on with this company?
I think we should start with the 3 viewer selected and recommended stocks.
Yeah, we had a few viewers that recommended some stocks, and thank you for that. Please keep sending them to us. This actually inspired us to do a couple of videos on some of the reasons why we may buy or may not purchase a stock. Those 3 stocks on the spreadsheet here are Zim International, Eagle Shipping, Golden Ocean Group. These are all shipping-based companies, and we found some things with Zim International in particular that we're not sure that people might be aware of. And there's so much there that we can't cover it in this video. So we're going to cover that in the next video. And you're going to see why we decided not to purchase that one.
We're going to do a whole video just on the analysis of Zim. Just for you guys out there, we're probably going to make a lot of Zim lovers angry at us. But I think it's very important that you guys understand where we're coming from and where you should be looking to pick out these stocks.
We did look at Zim before. Early this spring, there's a video where we talked about Zim as one of the recommendations, and we decided to hold off because there were some red flags. And since that time, the stock has cratered. It dropped a lot, not a little bit. So if you're looking at a company and you're going to buy a stock that pays a dividend, it's important to remember that you got to protect your principal too. So when we buy a stock, we have to make sure that the principal is okay. In this case, the stocks that we're purchasing are doing that. Now, I know some of them are dividend aristocrat stocks. Not all of them are. But what's the point of giving, let's say you bought Zim. Let's say you bought in the spring. If you buy Zim at $60 or $80 a share and they go down to 20, why would you be excited about their 30% dividend? Because you lost, 3/4 of your money.
Right.
So,
and we always say that in times where the stock market is in down period, to not sell because you're going to realize those losses. You might think that, okay, Zim's another example that we're going to buy at 60, it's going to go down to 20. Don't sell it. We won't realize those losses. We'll collect our 116% crazy dividend, and eventually it's going to go up. The problem is we're not positive that it's ever going to go back up, and you're just going to always have that loss.
The other thing I want to cover too is our portfolio this year has done very well. We've done well. The market's crashed. It's gone down a lot. Our portfolio has been pretty good, positive. The reason for that is during recessionary markets, the dividend stocks and safer investments tend to perform a little bit better than average. In a bull market, these same types of investments don't tend to do as well. If you look at my personal portfolio or Brian's, this year our portfolios are down more than average. Not as much as the S&P, we're still outperforming there and on the Dow, but as a result, we didn't buy, the dividend dudes bought their portfolio at a really good time. This is a good time to buy.
Yeah.
So that doesn't happen every year. So just because we did very good right now and this year does not mean we're going to be super crazy rock stars next year. We are buying these stocks to create passive income to protect your principal that will beat inflation and allow you to have a good lifestyle later on in life. Not tomorrow, not get rich quick, not selling you anything other than the fact that this is what Brian and I did to become successful. Yeah. This is how we did it. Yes, if you want to get into it, we can get into the stocks and you can see why we picked what we picked and what we did.
And if you have any recommendations, like the ones that we received already, go ahead and put them in the comments and we will look at them.
Yeah, please do that. I love looking at this stuff because I like the ability to help people and help them understand what this is. Because finance, well, again, the reason why we started the channel is because finance really isn't taught in schools, and there's not a lot of people out there that really understand how this stuff works. If we can help you, even if there's only one viewer, there's one guy, we will help you and do what we can just to show you that this is possible. It's possible for you to make this happen.
Let's start with Golden Ocean and Eagle Bulk Shipping.
Yeah, so these are shipping companies. They're relatively small cap companies. They have a lot of volatility inside of that because they're smaller. Now, shipping as an industry right now, and COVID has done pretty good over the past couple of years. But if you look at what's happening now with the Fed raising rates, now that's not just affecting the United States. The United States dollar is a trade currency for the world. If the bank raises rates here, you're going to see what happens to the central banking and IMF system in Europe. It's going to have a global impact. That's why China's freaking out. But there's more to it. So these shipping companies, especially the ones that have leased ships, they don't own these things outright, they're affected by those rates because these leases are up on, I think one of them was an annualized basis. If you had 1 year, you're getting a leased ship for 3%, next year it's 8%.
6 or 8, yeah. That's quite a hike.
That hikes things. So the other thing too is there's a lot of cost of goods changes in prices that is causing the numbers on these stocks to be very volatile. This is why on the viewer recommendation stocks, we're going to cover these in a separate video because like I said, there's a lot there. There's a lot to digest. There's a lot to unpack because when you see a number fluctuate from, if you look at Golden Ocean, you see a lot of negative numbers, a lot of dropping numbers, but they're actually honest numbers. Eagle Bulk Shipping too is another one that if you look at what's actually happening, net income quarter over quarter, and you kind of look at their dividend yields, it's hard for a company that pays that high of a dividend to be able to cover it when their operating margin and their net income quarterly is actually dropping. So if they're losing money, it's difficult for them to cover the dividend for a very long time. When we're looking at a company and shipping is not an industry that we're in yet in Dividend Dudes, so we'll probably
we're looking.
Yeah, we'll probably get into one of those companies soon, but we want to make sure that they can cover their dividend, and none of the ones in the market purchase here seemed like they could do that at least for a very long time.
Yeah. Right.
Yep. So.
And we're looking at 13% dividend for Eagle and 26% for Golden. So the dividends are quite high. It's like unsustainably high. And I understand why people want these because they want 26% return, right?
Sure.
I want that too. But if you're chasing dividends that way and you're not looking at the financials and their sustainability, you're going to eventually lose the dividend and your principal.
The other companies in the list here, we see there's a couple of real estate companies, there's a couple of REITs, a couple of banks in here, and one of them, the one that I wanted to look at was automatic data processing because I personally have shares in them. I've had them since like 2006. I've had this company a long time. Back then they didn't trade at $200 a share, but they were the best of the world and the worst of the world. It's like I look at them every couple of months or so, and the thing that we're hesitant about and why we decided not to buy any of the ones that were at least on the list at first, it was because of what the Fed's doing. When they raise their rates and they change the interest rates and they change the liabilities on things, that affects profit margins for companies in a big way. Plus inflation, we talked about that in the last video, that impacts the net profit margin of the company too. It could come in the form of employees asking for pay raises. It could come in the form of, hey, the guy gets on the phone and he says, I want to order more Campbell's soup. They want to order more metal for their soup cans, and all of a sudden it's twice the price.
Right.
So there's other reasons for that. It's hard for me to recommend, and it's hard for Brian and I to recommend any REIT or banking stocks until we see what happens with treasury yields and when we know the Fed says, okay, we're done.
This is it. This is what it's going to be for a while.
We're going to taper it.
And then we'll look at these again, and then we'll probably get back into the financial and or REIT.
Oh, it's so hard for me to do that too, because like if you look at some of the REITs, their finances for now,
Like right there, right on the edge.
they still look really good, but you can see the wave coming where it's going to be bad. And
Right.
it's like, man, you know, some of them were like, and Alley Capital's one we looked at a couple times now, and they were like 20% dividend now. But when you look at their cash flow and their balance and everything, it's just not there. Plus, if the rates are going up, how do you know that if a bank, a good example, a bank, if they wanted to lend somebody a car, interest rates went up. If that person can't pay for their car, then the bank doesn't make their money. So there's a kind of a snowball effect in the reverse directions. All of these companies in this list, Kronos, Stanley, PetMed, you know, they all had kind of problems that weren't all related to the same things, but one of them might have had a net profit problem, one of them might have had a net cash flow problem, and it all kind of piled up into us, and we were just looking at it as like, okay, well, let's look at some of the stocks we've had before. It might look better financially. We did look at the ticker symbol. We did pull into the news. We did look at critical support and threshold levels. We did look at where they were trailing 52 months prior to that. And after all of that, it came down to two, basically.
Two, yep.
Yeah, two companies. You want to cover it, or you want to?
Yeah, sure. We bought Honda.
Just like that.
Just like that.
Just like that. We bought Honda.
No fanfare.
No fanfare. We're so excited, Brian.
It wasn't a real moment where it was like, oh my God, we just found this golden nugget of a stock that we never would have found before. I mean, we know Honda. Honda's an evergreen stock. It just usually does very well in the market. It's not exciting. It's not wow, but
It's not an aristocrat either.
right. It's not aristocrat.
Pretty darn close.
There's nothing wrong with those. It's not, you know, it's not an ETF. There's nothing wrong with ETFs either. But as of right now, we don't have any stocks of that sector, and it's a decent stock.
Honda has cash flow to go through the chip shortage, logistics issues, and the upcoming recession to cover it. Not every company had that, so they had enough to cover their dividend. They had enough to cover basically all the upcoming expenses, and they were like the only company in the whole list that showed a positive revenue growth that we felt was stable, like an actual number.
Yeah.
Because some of these, like we looked at AVGO, and they showed like a positive revenue growth, but we both worked in IT for many years, so we know a little bit about that industry. The company looks pretty good, but I don't feel like their growth is going to be as stable. When you look at the volatility of the stock and you look
Right.
at the price changes that are happening in that stock, does that mean that AVGO is a bad stock buy? No, it might be a good buy.
No.
But today, right now, this is November of 2022, Honda seems to be the one that looks like it's a good buy this month. Now, we have quite a bit of diversification now, so we have to start breaking into industry sectors a little bit more. So we have to say, hey, financing, let's look at finances next month. And this is why the viewer recommendations, if you guys have ones that you want us to look at, just like these shipping companies, we need that now, because there's enough there where we can't just keep buying telecoms every month.
It's getting harder and harder to find good stocks that we don't already own.
But we knew that. I mean, we knew that when we started, and we have the diversification that's not quite there. It's getting closer. But it's to the point now where I think we're up to about
86.
Yeah.
$186 a year. So a little over $15 a month.
$15 a month. We're not even a year in.
Passive revenue.
So if you've been following along, you've been investing with us. You started with, I think we're at $3,200 that we've invested now, and we've gained, I think the portfolio is up like 2 or 3%. And that's not including dividends.
Right.
So that's really good. And we've got dividend checks of about $15 a month. $15 a month is like, yeah, whatever. But you've grown your principal, that money has increased, and you have passive income in a diversified portfolio that can weather some pretty good storms. You'll pull up the stocks, you can see the list here. That will kind of explain it for yourself, the different markets that we're in. And as we grow this, we'll do some annual reviews on stocks. We'll still review some individual stocks based on viewer recommendations, and we're going to probably pick maybe 2 or maybe 3 in a sector, and we're going to leave it at that. And then what you're going to do over time is you're going to take those dividends and reinvest them and increase the snowball and grow that. So after year 1, that if you had an auto loan, and we're talking about the very first investment we bought, AT&T, $400, that is now paid off in less than 2.5 years. So it's working.
Yep.
And if you're following along and you're doing this, Thank you. We want to know about that. We want to see people doing the same progress and getting the same results that we're getting. Keep sending us stuff. We'll build this. We'll build a portfolio that hopes makes us all successful.
Look for the Zim video in the future and watch this video on passive performance. And as always,
Happy
happy
investing.
investing.